So we're gonna go over basically some rather dicey IRS audits. We assisted someone about a year ago with an audit on their 2021 and 2022 audit. So the they are a small business owner, and the principal amount of tax that they wanted to go after was $109,000 for 2021, and then another $78,000 for 2022. After penalties and interest, those principal balances balloon. The 108 balloons to This 108 balance balloons to 147, and then that $78,000 balance balloons to $100,000. So it ended up being a $250,000 audit after various penalties, interest, etc. The amount due was 147 for 2021, 100 grand for 2022. So 250 grand the IRS is going after for this small business owner, which is a chunk of change that I think we can all agree on. So they do in an audit, what is good is they explain what they're going after. In this situation, something happened where they I didn't really get we didn't really get a chance during prior to the examination, prior to the audit to really even respond. They pretty much just assessed, but they do explain what they're going after. For them, they're going after various capital gains on capital gains. So stocks, various stocks, they had some discrepancies, taxable interest. The IRS has embraced some of these large language modules out there, some of these machine learning AI system platforms. I honestly, prior to this audit, have never seen interest get contested to this degree. Interest on the tax filing, we reported 48, but based on the exam, they believe that there was $108 of interest. So an adjustment of $60. I've never seen the IRS contest over $60 before, just because the time and effort to fight over $60 is so minimal. But because they have a little bit better technology with these large language modules, these AI machines, they're able to find some of the more minute details. Whereas prior to, you know, go back 5, 10 years ago, a $60 discrepancy, I wouldn't even ask about it. But they are dialing it in. But in terms of their business, the cost of labor was disallowed entirely. You can see per exam, it was zero. So for 2021, they claimed about $200,000 of labor. 2022, they claimed about $160,000 in labor. Per the exam, they completely disallowed labor in its entirety. And we'll look at that in a minute. Travel and meals as well. These uh these business owners for 2021 T&M, they only claimed $8,000 of T&M for 2021, about $12,000 of T&M for 2022. You can see on the exam they disallowed the T&M completely, and we'll take a look at what they're looking for on that so that way we can be better prepared. And insurance. They are really looking at insurance more now than prior years, because there's so many insurance vehicles that are not so much insurance policies but more wealth policies. So they want to make sure the insurance is indeed for the business owner, for the spouse of the business owner, for the family of the business owner. if we're paying for if we're paying for mother-in-law's health insurance and mother-in-law's life insurance, and we're trying to deduct that. They do look at insurance, surprisingly, to make sure the insurance is related to the business. Another thing that happens with insurance is I have some sort of mortgage insurance, some sort of landlord insurance if I'm a landlord, some sort of insurance that's not directly related to the business. We tend to just account for it in any type of situation under the business, even though it's not for the business. So just making sure that any insurance expense that we're trying to claim is indeed related to the business. And then their self-employed pension plans also got contested. They had They're making contributions to IRAs, SEP IRAs every year, $65,000 2021, $68,000 2022. So they're maxing it out. They're maxing out their retirement contributions. The exam disallowed it completely, surprisingly. And we'll take a look at why. Some various other just kind of nuanced uh, things that they looked at as well. So a pretty hefty audit, honestly, a real nitpicky audit. We are showing the actual tax filings so everyone could see, this is a good small business, top line gross of $600,000, just shy of. And really, we are showing a profit, line 31 net profit. We're showing net profit of $300,000. So to go from $556,000 down to a net taxable profit of about 300, we're not being overly aggressive with expenses. We are showing a decent degree of profitability. What triggered the audit for 2021, and then we also have the tax filing for 2022, so we can see we've omitted all of their sensitive information, so it's just numbers and words. The trigger of the audit, surprisingly, was because a decent amount of income and expenses are being reported on Schedule C on their personal filing. There is no business entity involved here, which, from the IRS's perspective, that's a red flag. That's one of the biggest red flags for the IRS is any type of business activity being shown on your personal tax filing. It pretty much tells the IRS either that you're doing your filing yourself or you have an accountant that's on the weaker end of understanding everything. Because once you hit about $100,000 of total income, $100,000 of profit or so, $100,000, once I'm at the $100,000 range, the majority of accountants that understand this game, they're gonna start getting you set up to separate business and personal. Some sort of corporation is in place, some sort of LLC. So now we have a business filing where all of my income and expenses are reported, and then I have a personal filing. So my business filing, I'm very likely taking a W-2, taking distributions. So my business filing has it all separately set up. And it's also far more tax advantageous as well to have that structure of separating everything. So the IRS, when they see something to this degree being reported on Schedule C, being reported all on your personal tax filings, it kind of opens up their eyes in terms of standing out. Uh, so that's what triggered the filing is the lack of any type of entities. So we got this situated. We got this situated. We did not, we didn't, we ran into a little bit of a situation where in terms of 2021, we owed $3,000. In 2022, we did owe $3,500. So we did have to, the taxpayers did have to come out of pocket about $6,500 to kind of end this, but a far cry from the $250,000 that the IRS was going after originally. How did we do this? Let's take a look at the updated explanation of items. So taxable interest, I could not get them to look away from taxable interest. They had an extra 1099 interest form from Bank of America or Citibank, some bank account they had cash in that they forgot about, and the IRS really wanted that tax on the $60. The IRS really wanted their 25% of $60, which is like what, 15 bucks. The IRS really wanted that $15. I should have just bought the IRS agent an In-N-Out gift card or something. I don't know. But let's look at T&M. Okay, T&M in terms of travel and meals. For those of us who are clients already, you'll you'll have noticed that we've kind of cracked down on T&M a little bit just because um, we're running into some of these audits where the IRS is really looking at travel and meals. We have what the IRS is looking for here for any travel and meals expense. So they want to know the amount of the expense. They want to know the time and place of the travel. Okay. The business purpose of the travel and the time the expense was paid or incurred. So those are the four things that they're looking for any type of travel or meals expense. So these four items, 75% of it is accounted for in some sort of bookkeeping system. I have a bookkeeper that's keeping up with my books quarter to quarter, month to month. They're reaching out to me month to month, asking me, hey, what was this for? What was that for? Or I have something with QuickBooks. Some sort of accounting system will allow me to figure out the amount of the expense, the time the expense was paid, the time and place of the travel. So 75% of this is accounted for just in a good bookkeeping system where I'm actually keeping track of these expenses, these tax deductible expenses. Okay. But the business purpose of the travel, the business purpose of the meal, okay, they want to know the business purpose. So if I went down to San Diego for the real estate convention or for the business owner convention, I went to some kind of business related convention. Yeah, that all adds up. We did a retreat as a company. We did some sort of retreat as a company to somewhere. Yeah, that's a legitimate business purpose. It can't be my wife and I went to dinner and we thought about the business. You know, uh, Me and a colleague, we went to lunch and we thought about investing. We talked about how we are gonna uh, 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 we talked about how we're gonna be better business owners. That's not really gonna fly. So in this situation, the business purpose of the travel, what happened in all of this is they kind of have a baseline of what they can allow just by kind of pushing against the agent. So you'll notice that and now that we were to go through all of this, they allowed 25%. It's either 25 or 30% just off of the 8 grand that we claimed and the 12 grand that we claimed. They allowed 25%, somewhere around 25, 30%. They allowed that off the bat. So they only disallowed 5 grand for 2021 and 7 grand for 2022. So once I let the taxpayers know that I got 25, 30% allowed just by kind of pushing against the IRS agent, they just didn't really want to go through the hassle of going back to 21 and 2022 and figuring out the business purpose of the travel. They just kind of said, okay, we'll eat the tax on this. It's not that much, a couple grand, good enough for us. We'll move on to the next task. And also insurance other than health. So again, insurance, making sure we actually have actual business expenses, that actual business insurance that is related to the business that we're running, trying to deduct, trying to deduct, insurance for my mother-in-law or insurance for mom and dad through the business. That's just not going to fly. But again, the IRS does has a baseline that I'm able to get them to push onto. So they allowed we claimed $16,000 for 2021 and $16,000 for 2022. They allowed 80% based off of the baseline that they can allow. And then they basically just disallowed about $3,300 for 2021 and 3 grand for 2022. So once I let the taxpayers know about this, they were just fine with it. They did have a situation where they were deducting an insurance expense for a real estate property that they owned through the business, which you can do. It's just they were deducting it through their operating business, not through their real estate rentals. So we should a little bit of an accounting oversight. Um, and then they did have some health insurance for their parents that they were trying to claim on their business filing. The the IRS looked at their healthcare package of health insurance. I think they had like Blue Shield or something like that, and the IRS noticed that some people outside of the immediate family and employees that were part of the company were on there. So not a bad adjustment, small adjustment. The other big thing would be the cost of labor. So you can see here that originally cost of labor, this is their biggest expense year over year. $200,000 of cost of labor for 2021 and $156,000 for cost of labor 2022. They hire contractors to help them. It's an environmental assessment business. They hire specialists to go out and help with reports. They bring the report back to the business owner, and the business owner basically takes their assessment and then basically signs off on it. So it's a good business. So all of his labor are indeed contractors. So what happened in all of this is they were indeed filing and issuing 1099s to their contractors, but something was happening 2021, 2022, these COVID era years, where the e-filing wasn't making its way through the IRS's servers, and the IRS was shut down for so long, so they're just completely relying on automation of their systems. There was no human to see that there was a problem. So a little bit of an e-filing issue, but we at least were every year issuing 1099s and preparing them. So doing something on your end to keep track of the fact that you are indeed issuing 1099s. I think email is the best thing. That's essentially what we showed them is like, hey, you know, here's the emails to all of the contractors that we indeed prepared and issued 1099s. Not so much mailing the 1099s, if we can email the 1099s or at least have a record of us requesting the W-9 to prepare the 1099s, that's a really good way to substantiate your 1099 compliance. So the cost of labor, once I showed them the history of 1099s, they pretty much wiped this out completely and the cost of labor stood. So going from $250,000 to only owing $6,500 was a pretty good day at the office. In terms of a time frame, in terms of a time frame on an audit like this, it does move a lot faster than a typical situation. So the audit started on March 13th and the audit closed. So started on March 13th. We got the determination on April 25th. So about a month and a half. Um, This was in the middle of 2024 as well when they passed the Inflation Reduction Act. So Biden was able to put more money into the IRS. So they did have better staffing in place. But, you know, we're still coming off of a federal government shutdown. The IRS has somewhere around 1 million pieces of mail that they're still going through. The IRS is, now that there's a new administration, the IRS is very underfunded and understaffed. So will an audit be done in a month and a half? I don't know about that right now anymore. But that's a good time frame, what you can expect. We have here, we can send this to you guys if you guys put your email or email us. We can send this presentation to you. We have a lot of the rules just to make everyone understand on what 1099 should be issued. 1099 MISC, 1099 NEC, the due dates, when I need to submit the 1099s. But the biggest thing with 1099s is $600. So $600, okay? If I'm paying someone, if someone's working for me in a in a contractor position, okay? If I pay them more than $600 in a year, I have to issue a 1099 to them. Which 1099? That's definitely a good question. And for the people that work with us, we essentially just finished that about a couple weeks ago, getting everyone's 1099 situated. But if I don't comply with this rule, as we saw in this audit, they can disallow those expenses for labor because we weren't compliant with the 1099 issuance. So now the $10,000, $15,000 for these people, hundreds of thousands of dollars of labor that I'm spending. Now I have that expense disallowed. So I'm essentially not only paying tax for myself, but I'm also paying the tax for the labor that I'm paying because I'm not compliant with these 1099s. And would really be up a creek, okay? 1099 INTs as well. So if we commonly see this in any type of situation where there's a real estate syndicate or real estate development, you know, I found a distressed property in an area. I found the parents just passed, the beneficiaries, the property's a disaster. The beneficiaries just want the money. They'll take a cash offer right now and then. So, I found a nice property in Anaheim for that was built in the 50s, hasn't been touched since the 50s. Original owners, the property is distressed as hell, so they're willing to sell it for $650,000, $700,000. But if I can renovate that property, I can get it on the market for one to 1.5, somewhere around there. So you reach out to people with this opportunity. You say, hey, if you can lend me $100,000, I can pay you back within 6 months, within a year at 15% interest. And then they say, yeah, that's way more than I'm getting in the bank. That's more secure than the stock market. Okay, I will invest with you. Here's my $100,000. When you give them back the $100,000 of the original investment plus the interest, if I'm paying someone interest over $10, I need to issue a 1099 INT to report that I paid someone interest, and then that person that received the interest then has to report the interest on their tax filing and pay the tax on it. So the 1099 INT, we have the information on that as well. And then a W-9. A W-9. This is the form that you have to give the person. They have to then fill it out and give it back to us. Okay. The W-9, based off of how they fill this out, that then tells us whether or not we even have to issue a 1099. So if they're a corporation, you don't have to issue 1099s for corporations. If there's different rules on when we do actually need to issue a 1099 versus when we don't. So good information for us to just refresh us. I do have one last kind of audit that I'm going to finish on. This is more for the real estate community. So, if you're a real estate professional, our firm deals a lot with real estate. It's one of the biggest aspects of our company. So, I had a no change audit for somebody in as well in 2024. This one was a little bit longer. This one started in March and it didn't end until June. Didn't end until June of 2024. So a little bit tougher of an audit, but this one was rare in that they completed the examination and they are not recommending any changes. So this is what they call a no change determination. So we were no change audit. That's essentially what we're looking for, where the IRS goes through everything and they say, okay, everything's just fine. We are on our way. No money is going to exchange based off of this audit. A big win for the taxpayer, a big loss for the I, the R, and the S. For this particular audit, this was a result of an inheritance. They inherited a whole portfolio of real estate, of stocks, IRAs. So the kids inherited it. The estate was a mess. The poor estate planning. So very little of it actually went through to the estate. A lot of it got transferred to the sole benefit, the one person, the one beneficiary, the one person that inherited it all. So instead of it being within a trust, an estate, it just basically went from the mom and dad. The mom was the last one alive. The dad had already passed. The mom was the last one alive, and then it went straight into their daughter's name. No trust really, because there was a trust, but the trust was a disaster. So now I have all of these rental properties, all of this real estate. Some of them are rental properties, some are vacation homes. So the IRS did audit the fact that we reported $51,000 of property taxes all of a sudden. I guess that kind of stuck out to them that how are you paying $51,000 in property taxes? So they asked about that. They asked about Schedule D. Schedule D is stocks. They pretty much wanted to look at all the stock activity. I think it was about a one to $1.5 million of stock activity. And then they sold one of the property. Property one was sold, and then property two. Remember, this is 2021. So they one of the properties they inherited. One of the properties they inherited was it appreciated so quickly in 2021 that they ended up doing a like kind exchange on one of the properties that they inherited. Uh, so. We had two properties actually sell that year, property one, property two. Property one was the traditional sale, property two was a like-kind exchange. But the biggest thing in all of this is for those of us who have a real estate background, okay, this audit was held up. I got this form here, information document. They're asking me questions on stuff that that they need, so that way they can move forward with the audit. So they wanted to know the biggest thing that held up the audit was the real estate appraiser license for John Doe. So there was a realtor involved in these transactions that the realtor, once they inherited the properties, they got a realtor to help them because they wanted to sell. They had a plan. So they got the realtor involved. And the realtor did a date of death assessment, a date of death market analysis. And I used that number. The realtor said, this property one is based off of the date of death. It's my opinion. He did a whole report that it's worth, $800,000. So I used that in the tax filing that the realtor says an $800,000 value of the property. But this realtor forgot on the report to put his license number. And the realtor was an Italian guy, had a real Italian last name. So, it was something like Snooky or something like that, Pauly D or whatever. So when you go to the California Board of Real Estate on the website, there's like 15 other guys with the same exact name. So the IRS agent was like, which one of these guys is your guy? And the brokerage that he was with in 2021, now I'm in an audit in 2024. He was with a different brokerage. So, if I don't I don't understand how you don't put your license number on an official report. I think that's a huge the taxpayer was not very happy to hear that I have an audit held up because the realtor that we use to basically assess all this and sell it for you, they forgot to put their license number on there. So I have to figure out which brokerage they're with now. It turned into like a week of trying to hunt this person down and getting them to update the report with their license number. So please have your license number on anything that you're doing. So that way, because if we use that for any type of reporting purposes, they need to know who it came from in case the IRS has any questions. On our end, all of our emails, we have because of this, we have since put our IRS practitioner identification numbers on all of our email correspondence. But I just feel like I think this is a huge failure that we can all profit from moving forward. Okay. Finally, the rules on audits. That way we understand them, the rules on audits. Okay. So the IRS has 3 years to open an audit. So we're coming up on April 15th, 2026 pretty soon. So all of our filings for tax year 2022 that were due in April of 2023. So 2022 is about to close. 2022, if we're not audited for 2022, the IRS has missed out. So anything we might have done up to 2022, we got away with it. Okay. But it's a 3-year statute to open an audit. All right. So if the IRS, if the IRS opens an audit, and they see anywhere in that audit that there is a 25%, a substantial error, they define that as 25%. So they define it as 25%. If they see anything in the audit that they started within the 3-year statute, if they see anything that's a 25% omission error, they can now open the audit to go back 6 years. So now your 3 years, they can now look into it 6 years. So now we got a little bit of a serious situation. Okay. And then if they open an audit in the 3 years, it opens to the 6 years. And in performing the audit, if the IRS can prove fraud, and remember that fraud is a willful intent. So I intended to deceive the government. I intended to not report that income. They have to prove that there was a willful intent in your actions. Okay. A rounding error by the accountant. That's an honest mistake. That's a human error. I forgot I worked for that employer for the 3 months I worked for them. That's an on. These are human errors. Okay. They need to prove willful intent in order for fraud to get proven. But if they can prove fraud, then the IRS audit opens up indefinitely, and we have a very serious situation, very likely a tax court situation that we probably need to get you're going to need litigation, so very likely a tax attorney is going to need to get brought into the equation. So these are the statutes on audits, so that way we're aware. Couple, couple more weeks, month and a half, we can pretty much all close 2022 on all of our ends. So that's pretty much it. Just a good education webinar on audits, what the IRS is looking for. We have our contact information here as well. Uh, this is probably one of the better emails to send, which would be Aaron's email. You can send email, Aaron's email. Our phone, both our California and our New York office both receive text if you want to text us. And we can definitely, if we run into a situation where we are under audit, we have some pretty good experience in all of it. So hopefully reach a great resolution. So, couple people here today. Bill, appreciate you showing up.
Glad to be here, Louis. Some good information there. I just sent you a text or a message on keeping files for past years. So it goes by the April to April date, not the actual year. So
Yeah,
2022, I mean, if is 2022 and we're coming up on 2026, we can get rid of all the 2022 files.
yeah, because remember that we always report like the year has to end. So 2022 ends, and then we have to file in the following year. So we filed everything for 2022 in 2023, right?
Okay, right.
Right. So it starts from the date of the filing, 3 years from the date of the filing. So 2023 is the year that 2022 was due. So come April of 2026, essentially 2022 is essentially is close out. And pretty much for the majority, it's a great question, Bill. For the majority of people, like if you haven't been audited already for 2022, like the chances of them doing anything for 2022 for you, or you're pretty much free and clear because it takes time for the IRS to open an audit, service the audit, and then close the audit. So even if you were for 2022, if they were to open an audit, let's say today, let's say we got an IRS notice, 2022 is now an audit. In order to close the audit, if there's any type of delay or anything like that, and we hit that April 15th, April 16th deadline, they would have to request, they would then have to request from the taxpayer, would you please allow us to extend the statute? And then you would say, no. Why the hell am I going to do that for?
Yeah,
It's you guys are the idiots that opened up an audit a month and a half before the statute was even going to expire, and then we have everything, we've sent you everything that we did, and you guys took too long to get back to us. So no, we're not going to give you more time.
right. Yeah, okay. Got it. Thank you for that.
Yeah, great question. And then in terms of the files, we actually on our end, we have like a pretty heavy server. We have a server of everything for all of our clients. We have everything that we've used to prepare a filing, everything we've documented in terms of why we did this, why we did that. We have it all on our server. So we have everything, a guy like you, Bill, that's been with us since, 2017. We have it going back to the infancy of the relationship.
Great. Good to know. Thank you.
All right. Appreciate everyone showing up today. Great session for everyone. Let's have a great Wednesday.
Thank you. Appreciate it. Bye-bye.